Recovery. Yep. Good. Expansionary. Good. Yes, it is expansionary. And don't be afraid to pick two answers back to the same answer back to back. In fact, maybe even 3 out of 4 times it might happen. The exam knows that you don't want to do that, so they'll give it to you. That's the peak. Well, not every answer is on the economic cycle graph. Not every answer has to be expansionary, contractionary, trough. Look at some of the other choices. The length of time would be duration. Yeah, duration refers to length of time. Like for how long were we below economic growth? For how long were we below the normal economic growth line? What length of time did the recession last? What length of time were we contracting? Because sometimes the deviation in the economy away from the long-term growth line can vary for a short period of time and then quickly return to the long-term growth line. Or the duration could be a longer period of time away from the long-term line before returning to that long-term growth line. Remember what the long-term growth line looks like? Do you remember what that long-term growth line looks like? So here's the long-term growth line that we've been talking about. You see how you go, that one line, that's a straight line, that's your long-term growth trend. It's a diagonal line going up. That's your long-term growth line. Typically, the U.S. economy moves over the long term in an upward trend. And the reason we know it's an upward trend is because the new highs are usually higher than the old highs. You see how the new peak is higher than the first peak. See how the second peak is higher than the first peak? And we also see, not only do we see new highs that are higher than the old one, we also see new lows that are higher than the old lows. You see the old trough, how low it is, and then you see the new trough. The new trough is the low point, but it's higher than the old trough. And that's how we know that over time the long-term growth is still upward. There's still an upward growth line in the long-term economy, characterized by new highs that are higher than the old highs and new lows that are higher than the old lows. But how long it takes to get away from this line, sometimes we're below the line, see where the contraction and the trough, and then we recover from the trough back to the line. The duration of time that we spend at any one of these places along the line, the length of time we spend there varies greatly, and that's referred to as duration. We hit the peak, but then how long did we contract for? Then we contracted, we hit a trough, we went below the line. Notice when we contract, we go back to the line, back towards it. From the peak, back towards the line. Then we could go below the line, hit the trough. How long did we spend below that line before we recovered? And then how long was the recovery until we got back to the line and started to expand? And then how long did we spend in the expansion phase? That's all referred to as duration. The amount of time that we spend at any one of these points along this is referred to as duration. We could contract for a short period of time. We could recover for a longer period of time. That's referred to as duration. The length of time away from the long-term growth line. See how the other line is bumpy? Because we're anywhere, at any time. We could be anywhere above or below that line. How long did we spend there until we get back to the line? That's referred to as duration. What does capacity constraints mean? Okay, yeah, they don't have enough product. They have orders, but they can't produce the product. Think of Tesla right now with the Model 3. They have 400,000 orders, but they can't get what they need to get these cars out. If that's the case, then they must hit the peak. That's the peak. Because when you're at the peak, you can't get your hands on the economic resources that you need, and more orders are going to lead to input shortages, like materials shortages, labor shortages. Because when there's a peak in the overall economy, not only is your company getting a lot of orders, but so is everybody else. So if you want materials, you're competing with everybody else who needs it. If you want labor, although the labor is fully utilized, it's going to take time to train people to get them up to where they need to be. If you want new labor, because you've expanded so much, so is everybody else in your industry. So eventually you hit the peak when the orders come in and you can't fill the orders anymore. That's a peak. Yes. Yep. Yep. Input shortages, you can't get the materials, you can't get the labor. If you want them, you're going to have to pay a premium price, and that's going to lead to higher costs. Yeah, it's going to lead to higher prices, and eventually people are going to say, I can't pay that price. That's how you know you're at the peak. Yeah, see, when you hit the trough, that means you have excess capacity, which is the opposite of capacity constraints. Having excess capacity means you have all this machinery and material laying around and nobody is asking for orders. Nobody's placing orders. That's the trough. Now, in number 9, you're hoping that demand begins to rise and you can recover. And then your profits will stabilize because they've been falling since the peak. They fell from the peak into contraction. Now, if you're at the trough, how do you know you're at the trough? If you had that excess capacity, then in number 9 it says firm profits begin to stabilize as the demand begins to rise. That means you must be coming off the trough and now you're in recovery. Sure. Because when you hit the peak, profits were at their high. So if they're falling from their high, then you must be contracting. Yep. Now we're at the trough in number 11. Excess capacity is the trough. Yeah, why is there an unwillingness to risk new investment at the trough? Because everyone thinks it's just going to get worse. And when you're at the trough, it looks like there's no end in sight, and it's just going to get worse before it gets better. So why risk money now? You'll wait. But the news doesn't stay bad forever, and then you start to recover. Remember, at the trough, unemployment is high. Confidence levels are low. Firm profits are likely to be at their lowest level, so why would you want to make new investments then? There's no demand for the firm's goods, or not much demand. Fewer customers are ordering goods. And that means all you're doing is reducing the size of your workforce and cutting costs. Why would you want to make new investments? So that's how you know you're at the trough. But it doesn't stay bad forever because we know recovery comes. How do we know recovery comes? Because we have a long-term growth line in this country, right, in our economy. We show that from the trough, there's the recovery. It's going to follow. We don't know how long, though. The duration is unknown. We could be at the trough for a while. We could be at the trough only for a few months or a few weeks. We don't know how long. The duration is unknown, but we will recover. We know that because we have higher highs and higher lows. The next trough will be higher than this trough. At least that's the way it's been for the last 100 or so years. Severity. Severity is intensity. So this refers to the fact that, take a look at the line again. Severity refers to, if you're in a trough, how severe is that trough? How far below the line are you? Are you just a little below the line? Or are you a lot below the line? How severe is that trough? So there's severity with regard to the trough. How severe is it? And there's also duration. How long did we spend there? Two different things to describe the trough. Every economic cycle can be described in those two terms. How severe and what was the duration? Expansionary is the first one. Yep, that's considered the first phase because you need to expand back to the line. Remember, take a look at the line again. Until you get to the line, recovering back to the line. Remember, when you hit the trough, let's go back to the line again. When you hit that trough, you need to recover and get back to the line. That's the final phase to bring you back to the line. Then your first phase of the next cycle would be expansion from the line. But you got to get back to the line to end the cycle. To end the cycle and begin the new one, you got to get back to the line and recover from the trough. Recovery is the last stage. Expansion is the first stage of the new cycle. So in 14, real GDP rising and unemployment falling, that's expansion. That's the first phase. Real GDP starts to rise, unemployment falls. That's the first phase. Final phase is recovery. When you went from the trough back to the line, you recovered and finished off that cycle. Now, 16. Fluctuations in the level of economic activity relative to a long-term growth trend are known as what? Fluctuations in the level of economic activity are referred to as business cycles. These are your business cycles. This would be expansionary. In expansionary, profits go up. GDP goes up, profits go up, but unemployment goes down. That's what you want to see. Yeah. 2 consecutive quarters of falling national output is a recession. And if you're like president at the time, it would be very hard to recover from that. You're probably not getting reelected. If you're leader of the Congress, you're probably getting replaced. You're getting blamed for this because we have a long-term upward growth line. This would be characterized as a downward growth line for 2 consecutive quarters. Now, it may not be severe, but if the duration is 2 consecutive quarters or more, you got a recession. Not every recession is created equal, though. They're not all severe, right? The severity is taken into account. Before we measure how severe the recession is, we'd see how far away from the long-term growth line we are. But if we're falling for 2 consecutive quarters of duration, that's a recession. Even if it's not severe, it's still considered a recession if it's 2 consecutive quarters. Doesn't have to be severe. If it's severe, it could be a depression. Right. A recession just means 2 consecutive quarters of falling output. Instead of the line going up, you're going downward for 2 consecutive quarters. Now, it doesn't mean you're severely going down. You just might be a little bit lower each quarter for 2 consecutive quarters. You're in a recession. Now, if it's a severe recession, if you're dropping dramatically, then it's a depression.